Hello and welcome. Today, we're going to demystify a really important topic: how to handle losses from house property under the new Income Tax Act 2025. Whether you're a seasoned pro or just getting started with taxation, understanding these rules is absolutely key for smart tax planning.
So here's our game plan for today. We'll kick things off by defining what a house property loss actually is, then we'll get into the rules for setting it off in the same year and what you need to do if you have to carry it forward. After that, we'll walk through a case study to make it all click, cover some crucial compliance points, and finish up with a summary of the absolute must-know takeaways.
All right, first things first. Let's get to grips with the basic concept here and look at a situation that many property owners will find themselves in.
So, picture this. You've paid all the interest on your home loan, you've got other property expenses, but when you look at the total rent you collected for the year, it's just not enough to cover those costs. What you have now is a financial loss. So, what do? Well, thankfully, the Income Tax Act has a very specific, structured way to handle this exact scenario.
Okay, so let's get a little technical for a moment. What exactly is a loss from house property under the Act? It's actually a pretty straightforward calculation. You start with the property's annual value. From that, you subtract your deductions, which are mainly the 30% standard deduction and, of course, the interest you paid on borrowed capital. If those deductions are more than the annual value, that negative number you're left with, that's your loss from house property.
Now, the Act doesn't just leave you hanging with this loss. It gives you a really clear two-part solution. It's all laid out in Section 109, which tells you what you can do in the same year, and Section 110, which explains how to carry the rest of the loss into future years.
Let's start with the immediate fix. What can you do with this loss right away, in the very same tax year it happened? Think of this as your first line of defense when you're planning your taxes.
The whole process, which is laid out in Section 109, has to be done in sequence. Step 1 is what we call an intra-head set-off. This is where if you own more than one property, you can use the loss from one to cancel out the income from another. Simple enough. But if you still have a loss left over, you move to Step 2, the inter-head set-off. Here, you can adjust that remaining loss against other kinds of income, like your salary. But there's a limit.
And this is the number you absolutely have to remember. It's a hard limit. Under Section 109, the maximum amount of house property loss you can set off against your other income is 2 lakh rupees. That's it. It's worth noting that this rule hasn't changed from the old 1961 Act, which is great for continuity.
So the obvious question is, what if your loss is huge, way more than 2 lakh rupees? Or maybe you just don't have enough other income to absorb it all. Well, this is where the real power of tax planning comes in, with the mechanism of Section 110, which lets you carry that loss into the future. Now listen up, because this is probably the most important rule about carrying forward losses. Any loss you carry forward under Section 110 can only, and I mean only, be set off against future income from the house property head. You can't use it against your salary or business income in the years to come. That's a critical distinction. And you don't have forever to do this. The clock is ticking. You get a maximum of 8 subsequent tax years to find enough house property income to absorb that loss you carried forward. If you can't use it up within that 8-year window, the loss just lapses. It's gone. And so is the tax benefit.
All right, enough with the theory. Let's put some real numbers to this to see how Sections 109 and 110 actually work together in practice. It makes it so much clearer.
So let's look at year 1. We have a taxpayer with a pretty significant house property loss of 5 lakh rupees. Now, in that same year, they can immediately use the maximum allowed, 2 lakh rupees, to set off against their salary income. That still leaves a balanced loss of 3 lakh rupees, which now has to be carried forward under Section 110.
Okay, now let's fast forward to the next year. Things are looking better. The taxpayer now has an income of 4 lakh rupees from their house property. This is where Section 110 kicks in. They can take that entire 3 lakh rupee loss they brought forward and set it off against this income. The result? Their taxable income from house property drops to just 1 lakh rupees, and the loss is completely used up. Perfect.
All right, let's switch gears a bit. This next part is absolutely critical, especially for all you professionals and diligent taxpayers out there. How does these new rules in the 2025 Act work with the old 1961 Act? And what are the compliance requirements you just cannot afford to miss?
So the good news here is that the government has kept things consistent. There's no major change in how the mechanism works. As confirmed in official FAQs and under Section 536 of the new Act, the core principles,
that 2-lock limit, and the 8-year period are all identical. This means any losses you calculated and carried forward under the old act can be seamlessly brought forward under the new rules.
Okay, if you remember only one thing about compliance from this whole explainer, let it be this. To earn the right to carry forward a loss, you must file your tax return on time. The law is crystal clear on this. As the FAQs point out, if you filed a loss return late under the old act, that right to carry it forward is gone. Forever. The new 2025 Act does not give you a second chance.
All right, we have covered a lot of ground. So let's pull it all together and quickly recap the absolute key takeaways on setting off and carrying forward your house property losses.
Here are the 5 things to burn into your memory. First, that 2 lakh rupee cap for same-year set-off against other income. Second, you have an 8-year window to carry forward the rest. Third, and this is a big one, that carried forward loss can only be used against future house property income. Fourth, the absolute non-negotiable rule of filing on time. And finally, the good news. The transition from the old act is seamless.
And that's a wrap on Section 110. I really hope this breakdown made things clearer for you. If you found this useful, we'd really appreciate it if you'd like, subscribe, and share it with others who might benefit.
And just a final, important reminder. This video is for educational purposes only, and it is not professional advice. Tax laws can get very complex, so please always consult a qualified advisor for your specific situation.